An individual retirement account, the IRA, is one of the most common retirement savings accounts outside the employer-sponsored 401k. In the United States, anyone with an earned income can open and contribute to an IRA. However, there is one important decision you need to make before contributing to one: to invest in a Roth IRA or a traditional IRA. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Today, we're going to deep dive into Roth and traditional IRA. Understand what they are, and most importantly, determine which one might be the best one for you. But first, let's understand what individual retirement accounts are in the first place. As mentioned earlier, anyone with an earned income can open and contribute to an IRA. And a quick note here, earned income here has to meet the IRS definition. Income from interest and dividends, Social Security benefits, or child support does not count. However, if you have earned income like wages, salaries, commissions, tips, bonuses, or net income from self-employment, you qualify to contribute. The one major limitation is on the combined total that you can contribute to a retirement account in a single year. We'll cover that contribution limit later in the video. Also, an IRA must be opened with an institution that has received Internal Revenue Services approval to offer these accounts. Choices include banks, brokerage companies, federally insured credit unions, and savings and loan associations. And when you open an IRA, you can choose to invest in a wide range of financial products, such as stocks, bonds, exchange-traded funds, and mutual funds. There are even self-directed IRAs that permit investors to make all the decisions and give them access to a broader selection of investments, including real estate and commodities. And there are also several kinds of IRAs on top of traditional and Roth IRAs. There are SEP IRAs and simple IRAs. Each has different rules regarding eligibility, taxation, and withdrawals. In this video, we'll talk only about the two most common ones, the traditional IRA and the Roth IRA. And also because IRAs are meant for retirement savings, there's usually an early withdrawal penalty of 10% if you take money out before the age of 59 and a half. There are some notable exceptions, withdrawals for education expenses, for example, and first-time home purchases, among others. All right, let's now deep dive into the difference between a Roth IRA and a traditional IRA, starting with the traditional IRA. The main difference between a Roth IRA and a traditional IRA is how and when you get a tax break. Contributions to a traditional IRAs are tax deductible, but withdrawals in retirement are taxable. To give you an example, let's say you put $4,000 into a traditional IRA. Your taxable income for the year decreases by that amount. If your original taxable income was $100,000, it is now $96,000. However, when you withdraw the money in retirement, both the initial investment and the gains it earned are taxed at your income tax rate in the year you withdraw it. In essence, your money grows on tax-deferred basis in a traditional IRA. If you don't have a retirement plan at work, your traditional IRA contributions are fully deductible. But if you or your spouse have a retirement plan at work, such as a 401k or a 403b, your modified adjusted gross income determines whether and how much of your traditional IRA contributions can be deducted. I want to note that this doesn't mean you can't contribute to a traditional IRA if you're outside the modified adjusted gross income. It just means that you won't receive the benefit of tax deduction. For example, for 2022, if you're single or file as a head of household and have a retirement plan at work, your traditional IRA contributions are fully deductible if your modified adjusted gross income is below $68,000. If you're married filing jointly, your modified adjusted gross income must be less than $109,000. From there, you begin to lose deduction as your income increases. We all have our unique situation, so I'll have a link to the IRS website below in the description so you can understand where you fall with your specific situation. Another thing to note regarding the traditional IRA is what is known as required minimum distribution, or RMDs. Starting at age 72, holders of traditional IRAs must begin taking RMDs, which are based on account size and the person's life expectancy. Failure to do so may result in a tax penalty equal to 50% of the amount of the required distribution. All right, let's talk about the Roth IRA. In comparison to traditional IRA, contributions to Roth IRAs are not tax deductible, but the withdrawals in retirement are tax-free. You contribute to a Roth IRA using after-tax dollars, but you do not have to pay any taxes on investment gains. When you retire, you can withdraw from the account without incurring any income taxes on your withdrawals. Contributions can also be withdrawn at any time without taxes or penalties. This is because you've already paid taxes on it when you contributed your money into a Roth IRA. In addition, Roth IRAs also do not have required minimum distribution, the RMDs. If you don't need the money, you don't have to take it out of your account. And you can still contribute to a Roth IRA as long as you have eligible earned income, no matter how old you are. An important fact to note regarding Roth IRA is that there are income limitations for contributing to a Roth IRA. The phase-out range for single filers is between $129,000 and $144,000 in 2022. For married couples filing jointly, the phase-out range is between $204,000 and $214,000 in 2022. There's a contribution limit for both the traditional and the Roth IRA. For the year 2022, the annual individual contribution to an IRA cannot exceed $6,000. If you're 50 or older, you can contribute up to $7,000 per year. The extra $1,000 is considered a catch-up contribution. Alright, now that we have a good understanding of the general difference between traditional IRA and a Roth IRA, let's see how we can decide which one is best for us. To start out, we want to ask ourselves a few questions. The first question being, do I think my tax rate will be higher or lower in the future? If we can answer that question definitely, we can theoretically choose a type of IRA that will give us the biggest tax saving. If I expect to be in a higher tax bracket in retirement, choose a Roth IRA and its delayed tax benefit. If you expect to be in a lower tax rate in retirement, choose a traditional IRA and its upfront tax advantage. Now, if this seems like an ambiguous question because I'm so far away from retirement, no worries. Let's move on to the next question, which is more straightforward. Which one am I eligible for? As I mentioned earlier, there are IRS rules regarding IRA eligibility, primarily determined by our income. Our income determines if we're even eligible to contribute to a Roth IRA, and our income determines how much of our contribution to a traditional IRA we can deduct from this year's taxes. Note that traditional IRA deductibility is restricted only if we or our spouse has access to a workplace savings plan like a 401k. I'll have a link to the chart in the description below, but let's take a look at a couple case scenarios where your eligibility may make a determination for you. Scenario 1. Let's say that you have earned income, but your employer doesn't offer a 401k. This is actually not too uncommon. According to Bureau of Labor Statistics, in 2020, some 1/3 of private industry workers didn't have access to an employer-sponsored retirement plan. A lot of small businesses just can't afford an employer-sponsored retirement plan. And let's say that your income puts you in a high tax bracket and you're looking for ways to lower your taxable income. In this case, a traditional IRA might be a good option. It lowers your taxable income, and the deductibility restriction doesn't apply because you don't have an employer-sponsored retirement plan. Let's look at scenario 2. Let's say that you do have a 401k plan at your work and your income is above the IRS deduction limit, but below the Roth IRA income limit. If you're married filing jointly, this would mean your income is higher than $129,000, but lower than $204,000. In this case, you would want to contribute to a Roth IRA. You won't receive the tax deduction of the traditional IRA anyways, so it would be better to contribute to a Roth IRA in order to receive the tax benefit and withdrawal down the line. One caveat here is that even if your combined income is above the Roth IRA income limit, there is still a way to contribute. I have a detailed video about the backdoor Roth IRA you can check out here if you'd like to learn more. Alright, with that said, let me share with you my personal preference. For me, I believe that for most people, it's better to go with a Roth versus a traditional IRA. Let me share with you a few reasons why. First is that if you already have a traditional 401k, a Roth IRA provides additional tax diversification in retirement. The classic 401k plan offered by most employers provides the same tax benefit as a traditional IRA. Although some workplaces offer a Roth 401k option for employees, if yours doesn't, diverting some of those retirement saving dollars into a Roth IRA will give you more options for managing your tax burdens down the line. The second reason is the fact that early withdrawal rules are much more flexible with a Roth IRA. Although early withdrawals from retirement accounts are generally discouraged, if you do have to pull some money out for unexpected emergencies, the Roth IRA allows you to withdraw contributions at any time without having to pay income taxes or an early withdrawal penalty. And to clarify, the contribution is the initial money you put into the account, not the earnings it made. On the other hand, the IRS isn't as lenient regarding dipping into a traditional IRA before retirement. We'll likely be hit with the 10% early withdrawal penalty and owe taxes at our current income tax rate on the money we take out. There are a few exceptions to this rule, such as qualified high education expenses and first home purchases, but we'll need to proceed much more carefully than we would with a Roth. The third reason I like the Roth is that it has fewer restrictions in retirement. The traditional IRA requires you to start taking required minimum distribution, the RMD, at age 72. The government gave its tax break early on and will eventually want its taxes. Roth IRA, on the other hand, doesn't have the minimum distribution rules. If we don't need the money, we're free to let our investments stay put in the account to continue to grow tax-free as long as we live. With the average lifespan nowadays around 80, imagine what 20 additional years of compounding can do to our wealth. The key benefit of a traditional IRA for most people is the upfront tax break. And I'm not dismissing this benefit. It can be a huge advantage for high earners who don't have access to a traditional 401k plan, but will eventually have to face a tax burden in retirement. We don't know how the tax landscape can change in the future, so I like the idea of having no tax burden in my retirement if I could help it. Thank you guys for watching. If you'd like to learn more about retirement plans in general, check out my video here. Until next time, all the best.